Hello and welcome to ET Now. You're watching IPO Central, and my guest today is from Meesho. It's a technology platform driving e-commerce in India. Its IPO is opening on December 3rd and closes on December 5th. Price between 105 to 111 rupees per share. It has a fresh issue of 4,250 crores, OFS of 1,171 crores. So total size of the issue is 5,421 crores, and that gives the company a value of a little over 50,000 crores at the upper end of the price band. Joining me is Vidit Aatrey, who is the CMD and CEO of the company, and Sanjeev Kumar, who is the co-founder of the company. Gentlemen, thank you very much for joining us on ET Now. Vidit, let me start with you. It's a technology platform catering to e-commerce. Give me your business model first.
Yeah, so our mission statement is very simple. How do we really democratize internet commerce for everyone? That includes consumers, businesses, everyone in the logistics ecosystem. Over the last 10 years, we have built a very vibrant ecosystem that offers a very strong value proposition around affordability to our consumers. We have grown to become the largest e-commerce platform in India in terms of the number of customers that we serve as well as the order volumes that we do. So for the last 12 months ending September, we had 23 crore customers in India who bought at least once, and we did 230 crore orders. Both of these are the highest for any e-commerce platform. And the way we monetize our platform is through the services to our seller partners. One is through the logistics services, and second is the advertising services. We have a product that allows them to promote their listings on our platform. And because of that, you see consistent growth in our contribution margins over the last 2 years.
You're raising 4,250 crores in primary issuance. What is it going to be used for?
So we're going to use the proceeds to growing our ecosystem. So we are doing a lot of investments through word-led technology as well as AI, and I will ask Sanjeev to kind of talk about it. And the second thing we're investing towards is basically growing our annual transacting user base. If you see, for the last 2 years, it has been growing at a very good pace. Last year at about 30% year on year. So there is still a lot of growth potential in growing number of customers. So marketing spends towards making that happen is a big focus area for us. And we are also looking at, can we find some inorganic opportunities over the next coming years? Anything that is aligned to a mission statement would be interesting for us. So Sanjeev, can you talk about our tech investments?
So we rely heavily on AI to simplify the consumer experience, right? Like, it's extremely important because the kind of consumers that we are catering to, like, they need simplicity in shopping experience, and especially because about 75% of the orders today comes from ranking and recommendation real estates, which means people are not explicitly telling us what they want. We get clues from them basis the kind of categories that they're browsing, the products that they're spending time on, and so on. So a big focus area is for us to kind of continue to upgrade the ranking and recommendation models to state of the art, and this field is evolving pretty fast with the latest generative AI models coming in. It's also more important to continue to figure out how do we use and how do we improve shopping experience in the best way possible. Also, with Gen AI coming in, there's a potential to disrupt the entire shopping experience. So if you look at the current shopping experience, it hasn't largely changed over the last 2 decades. It's a feed of static images and maybe some videos. But if you compare that to offline shopping, that's very conversational in nature. Today, already in the current tech stack, we have capabilities through which we have automated largely our customer support chat and a decent percentage of our customer support voice calls, again through in-house built AI. We plan to use the same capabilities, enhance it, and use it in shopping to help new users who are coming to the app, to help them navigate through the app, find the relevant products, so create a lot more engaging and conversational experience. So this is again a new bet that we're exploring.
With it, you have a unique model. You provide services to businesses. You don't charge commissions, and you don't have a platform fee. Give me a sense of the revenue generation model that you have.
Yes, so as I said, like, we monetize today via 2 things. We offer logistics services to our merchants, And because today Meesho has the lowest cost logistics platform, Valmo, we are able to offer a much better value proposition in terms of affordability to our consumers, while also basically monetizing there. We are able to charge through a markup in our logistics fees. Second is a lot of our sellers who want to grow on the platform, they are willing to spend on ads. And if you look at globally, some of the largest value commerce platforms in geographies like China, Southeast Asia, Latin America have been able to grow profits a lot through advertising services to their merchants, which is what we are doing. In both of these, we have a long runway of growth, of growing our revenues, both in terms of logistics as well as advertising, and get to similar levels of profitability as you see in the global markets.
And so, if I'm not wrong, the driver for your profitability or revenue growth would be volume growth on a year-to-year basis. And how much of a leeway that you will have with respect to the kind of logistics services that you provide, or getting better realization from logistics, because many of the logistics players are loss making in this business.
Yes, so I think you can even see it now. We've been consistently reducing our cost of logistics because we become more efficient. We created this Valmo platform, which is an innovation in the logistics ecosystem that kind of reduced the cost even more. And hence we have been able to pass back a lot of that value to our consumers, make value proposition even stronger while also making money in the process. So there has been a lot of opportunity there. Just talking about growth, so if you see the last 6 months of this year, our NMV grew at about 44% and our orders grew at about 50% year on year, right? Which is very, very different than anyone else in India. So we are definitely growing really fast, and we believe we can continue to grow much faster than the market for the next few years. That is reflected in some of these numbers. So I think all of that points to very high potential of monetization, both through logistics as well as advertising in the coming years.
Yeah, but I'm seeing your numbers as well, where your advertising and marketing expenses have also gone up in the last 6 months, accounting for nearly 9% of the net merchandise value there. Is that the going rate for growth going forward, that your marketing and advertising expenses would be in that range of 9%?
No, I think it's just a matter of time. So if you see last 2 years, we have been able to improve our value proposition to our consumers quite a lot. And because of that, we saw a very attractive CAC, which is cost of acquisition of customer, and payback periods. So we said, like, why not go out and aggressively acquire these consumers? And that's reflected in our growth. So because we saw very strong payback periods, we are willing to invest. We internally have very strong financial discipline. We only invest if we are seeing a certain IRR return on all our investments. So I think because we are seeing very attractive growth, we are willing to kind of spend marketing. But if, for example, tomorrow we see we can't acquire new customers at the same pace, you will see some of these spends going down. So I think it's just because our value proposition is much stronger, we believe it's the right thing to do for the long-term platform to basically go out and acquire these consumers.
Sanjeev, you spoke about how you're going to use machine learning and generative AI. How is that helping you in acquisition of customers and retention of customers?
Great question. And I think AI, so the way we use AI in the marketplace is each and every critical decision making is driven by AI. So right from when consumers come to the app, they open the app, the feed is hyper personalized for each and every customer. So on the marketing side, for example, when a new customer comes to the app, it's extremely important to understand and predict what are this new consumer's preferences going to be. And it's harder because then you don't have enough data about that customer because it's a new customer. So we've in fact invested in AI algorithms to kind of make it work with limited data points, because we do profiling, we do a bunch of other pattern matching to understand what kind of products is this customer going to like a lot more, right? I think that is one. even beyond that, we continue to optimize the entire funnel after a consumer comes to the app, which helps in reducing the payback period of that CAC. So as consumers continue to come to the app and transact more, that naturally helps in building retention. So if you see today, we have the highest amount of time spent per consumer per day on the app, and that is because the kind of feed that we show to users, it's just so engaging, it's just so relevant for the customers that they continue to browse and continue to keep coming back to the app, which naturally helps in kind of having much better retention than anybody else.
And how does it help you to penetrate into cities like tier 2 and other cities? Because my understanding is that you've been able to do that much better than others.
Yeah. So there are a few things here, right? Like first and foremost, the shopping experience needs to be extremely simple for these users, because many users who are now who have been coming to Meesho, they are buying online for the first time. Now, most of the other apps that they would be using would be maybe WhatsApp. So you have to keep the experience extremely simple. So if you look at our app today, it's a simple feed of personalized products. There are no banners, there are no widgets, there are no complex decision making that is required to navigate the app. Even simple thing like address. Like if you go to small towns in India, address is not very structured. So you don't have like flat numbers, a clear street name in many cases. So we have built this technology, we call it Geo India LLM. What it does is, it understands Indian way of describing address, like 300 meter from this petrol pump, take a right. This is very typical way of describing address in small towns. So this AI model understands it and converts it to a location on a map, which is then we are able to deliver. I don't think most people out there are able to understand this kind of address and deliver it to our customers. So we rely heavily on AI to make it work at our scale.
Given that there is no commissions, there are no platform fees, are the discounts which are offered on products entirely borne by the sellers?
Yes, so today, like all the discounts are by the seller. If you look at even the way we do GMV and NMV calculation, we don't even include the discounts that some of our sellers offer, right? So it is basically including the checkout value because of the same philosophy. And I think since you're pointing to some of these things around, hey, should you need a platform fee or should you need commission? If you look at for the last 2 years, we have been free cash flow positive as a company. Last year, we generated about 1,000 crores in cash. And if you compare us to all the listed e-commerce companies, this FCF is the highest among most companies, right? So I think as a company, we will continue to prioritize this even going forward, have much higher levels of growth than the market while optimizing for free cash flow, because the company eventually is valued at the net present value of all the future cash flow that the company generates, right? So we will continue to kind of maintain this financial discipline, make sure that while we keep scaling, we are obviously also expanding the free cash flows in our business. And we don't think that you need to kind of charge a platform fee or a commission. We take a long-term view to our ecosystem. If you want to bring the smallest to the biggest of businesses in India, you have to reduce the cost of doing business or the barriers that they have. And if you start to, for example, charge commission, a lot of people cannot participate in the e-commerce economy. And our big focus area is to kind of bring everyone in India online and help them grow their business online.
Good that you touched upon the cash flows. In the last 6 months, you had negative cash flows from operations. Why was it that? Why was it the cash flows from operations negative in the last 6 months, first April to September?
I think if you see overall for the last 12 months, even ending September, we had positive cash flows. If you, for example, look at quarters, it could look plus and minus because of how certain sale events could be. There's certain kind of seasonality in our business where sometimes during Diwali or Holi, sales spike. But if you look at last 12 months and we put that metric in our RHP, even there about 580 crores of positive cash flow. So we believe that's the right metric to kind of evaluate the free cash flow profile of the business.
I was reading through your RHP and it said that the cash flows were negative because income tax was paid by the company for the exercise of ESOPs by the promoters. The perquisite tax which has been paid by the company, it's been paid by the company and not by the promoters. Why is that?
I think it was basically part of the one-time restructuring because we are bringing the company back from US to India, and at the same time, because we as a company going public, we becoming promoters cannot hold ESOPs after going public. That one-time restructuring happened, which is bringing the company back. So that's why the tax was paid, and perquisite tax was part of that one-time restructuring. None of that basically would be there after the company is public. It's already been paid for.
What about going forward? ESOPs would be there. You are a startup. You would be paying talent, especially talent which is in the AI space, where you're hiring a lot of people. How will the ESOPs going to be accounted for? Is it going to be exercised at market price, or will it be at a discount?
So first of all, I think ESOP, whatever ESOP amount that we needed, we have already carved it out. Our existing investors basically carved it out, and we believe that bucket should be enough for the coming years. So we don't anticipate upcoming dilution for our investors coming from there. In terms of like what strike price do we give ESOPs to our employees, we basically take an approach of giving the market standard, because eventually you're competing for talent with other companies in the same ecosystem. So what we do is we benchmark with what are the other policies that some of the other companies who we compete for with talent, they do, and we actually follow the market practice. So it's not that we are doing something which is quite different than everyone else. We basically follow the market practice in deciding what should be the strike price for ESOP grants.
Impact your P&L going forward in that sense? Will it be because if you're paying at a discount, then the entire charge differential has to be charged to the P&L. That puts pressure on your EBITDA. So is there a path to profitability that you are looking at?
Again, I already talked about like the free cash flow profile, which is what we look at. We will continue to kind of optimize for that as we keep scaling our business. Now, in terms of the ESOP charge, I think there will definitely be an ESOP charge that will be there. And if you see that number has been coming down, we believe it will stay range bound. We as a company is not planning to kind of grow our headcount a lot. You will see that in the last few years as well. As we get more and more operating leverage, that as a percentage will continue to go down at a certain pace. But as I said, like at the end of the day, we're competing for talent with some of the other companies. So we follow market practices around how some of the ESOP grants would happen. We will continue to communicate the exact charge that will come to the P&L every single time. And it's not that, like, for example, it's not part of the P&L. We continue to optimize that number as we keep scaling.
And in general, our approach has been to kind of use technology to solve problems. And if you look at even the current headcount, and we have shared that in our RHP, that continues to be much lower than anybody else at our scale, or in fact even lower than our scale, right? And if you look at the current composition, about 57% of our current headcount is techies, which creates a lot of leverage in the long term, operating leverage in the long term, which helps us continue to take newer bets, continue to solve harder problems while not growing headcount in the same proportion. In fact, if you look at the latest advancements in GenAI, it helps in improving productivity like across entire company. I think more so for engineering and product and data science and so on, right? So we also believe that if we are able to use the latest advancements in GenAI in the right way, we'll be able to kind of get a lot more and create a lot more kind of value from the existing employees itself.
The reason I was asking this was, once you come to the market, the street will be looking at your profitability pathway. Is there a definite pathway that you will become you are cash positive as of now, in cash flow positive, but is there a pathway to become PAT positive in the near term?
Again, we take a very long-term view to this At the end of the day, we don't want to optimize for some accounting metric. As I said, any company is valued as the net present value of the future cash flows that the company generates. If, for example, we optimize for anything else, we believe we are not like optimizing for our shareholders, creating the right value for them. So as we keep making progress, as our revenue and logistics and advertising grows, even some of the metrics you're quoting, PAT profitability, etc., will keep improving. But the thing I want to highlight is we believe the right bottom line metric for us is actually free cash flow, and that's the thing that we will continue to optimize for as we scale our business.
To get a final comment from you on the new labor code which has come into being. Valmo is one of companies which may be impacted because of the kind of the manpower they have and the last mile logistics that you manage. What could be the impact of the new labor code for your company?
I think as a company, we always follow the law of the land, and we'll be very, very compliant even to this. We're still assessing the impact of this to our ecosystem. As we mentioned again and again, we bring existing logistics companies, small and large, across the country to basically serve our users on the platform, and we will see like what kind of exposure it brings to that, and we will stay compliant. So we still haven't figured out what kind of exposure would that have onto our platform. But I think as we get it, we will kind of communicate it. But we will be compliant as a company to the new labor codes as well.
Vidit and Sanjeev, it was a pleasure talking to you today. Thank you very much for joining us on ET Now, and coming on IPO Central is one of the largest IPOs seen by the market. 5,421 crores is the size of the IPO, opening on December 3rd and closing on December 5th. Thank you for coming to ET Now and giving us your perspective on the company. Thank you.